I'm about to give everybody some game, some real game. I love math, and we're going to talk a little bit about some math that makes it all worthwhile. So, first thing we're going to start with is the rule of 72. So, 72 divided by your rate is going to help you figure out what the return on your investment is. So 72 divided by the return is the number of your investment. So a 10% return will double your money in 7.2 years. Next up is the rule of 2000. So 2000 times your hourly rate is roughly your annual income. So if you're on $20 or £20 per hour, that's roughly 40,000 per year. The next up is the rule of 4x. So 25 times your annual expenses is almost as is the amount that you need to retire. So 25 times your annual expenses is how much you'll need to retire, and you should be thinking about your retirement at all times. So if you have 60,000 in annual expenses, then you need about 1.5 to retire. The rule of fourths, so your home, or I really should say your mortgage, should not be more than 4 times your annual income. Now, this isn't something that you'll be able to completely control, but you should look to have a mortgage that is no more than 4 times your annual income. The house price is your mortgage plus the deposit that you pay down. Next up, we're going to talk a little bit about buying a car. So your car down payment of 20% for 4 years with a monthly expenses no more than 10%. What that is saying in numbers terms is a $20,000 car should have a $4,000 deposit and a loan term of approximately 4 years. Now, the 10x rule, this one is important because we should all be thinking about life cover and protection. And we will go into a little bit more about protection a little bit further on. But your insurance policy should be roughly 10 times your annual salary. These are things that we need to talk about, and we're going to get into all of those things and more coming up. No one can convince me that there is a lack of financial literacy, because the truth is every bank, every financial institution, most governments, most organizations are trying to give you the information you need to be more financially savvy. Now, I've added my 2 cents. I've released a book called A Mortgage is a Really Big Loan. But don't be put off by the title. It's not just about mortgages. We're going to give you the information you need to manage your finances better. You can check out the QR code. You can order it right there. It's available on Amazon. It's a great gift if you know young people who are getting ready to go to university, or if you know people that have recently relocated to the UK and they just want to understand how the UK financial system works and they just want practical advice, guidance, and information, this is the book for you, or this is the book for them. Make sure you get it on Amazon. You'll be glad that you did. All right, let's think about this. We need to be proactive with our finances. Our finances are made up of 3 key things: our credit, our income, a deposit if you're buying a house, and protection, which is insurance. We're going to go through all of those things. And here are a few questions. Let's see if you know the answer to these things. What is the difference between revolving credit and fixed term credit? Next up, when is the last time you checked your credit report? And lastly, what are the rules of intestacy? So if you die without a will, who gets the money and in what order? There's a lot of misconceptions about those things, and we're going to just cover those things off. First bit of advice: make sure that you check your credit report at least once a year. My advice: check it at least every 6 months. Why? If there's something wrong on your credit file, you need to resolve it as quickly as possible. There are a lot of scams out there. There's a lot of identity fraud, lots of things going on. And what you don't want to happen is when you go to buy a new car or you go to apply for a mortgage, the mortgage broker pushes your application back saying you're not going to be able to get the best rate because you have credit issues. It can take up to 4 months for credit issues to be resolved. That's if it's straightforward. And that's if you get it resolved quickly. It will take a while for it to update on the credit report. So if you know about these things and you can head them off at the pass by understanding what's going on with your credit report, then you'll be able to resolve these things quickly. I've worked in finance for over 30 years, and I know more about credit than most people. I've probably forgotten more than most people know about credit and credit cards and credit reporting. Remember, it's your credit profile and not just your credit score that's important. So what I mean by that, it's how you manage your credit. One of the questions that people frequently ask is, should I accept credit limit increases? And let me caveat the answer, as I always caveat, everything is very individual, everything is very personal, and we want to make sure you're managing your credit well. But if you are trying to build a better credit profile and a better credit score, you do want to accept credit limit increases. And with lenders who haven't offered you a credit limit increase and you've had the card for more than a year, you've been paying it well, you can request a credit limit increase. Why do you want to do this? Well, think about it this way. Lenders want to know that other lenders want to lend to you. And the way that they assess this is they will look at a snapshot of what credit you have available. So if in year one, let's just say you had £5,000 worth of credit available to you, and then year two, you still have only 5,000, and year five, you still have only 5,000. Lenders will think that other lenders don't want to lend you more money or that they don't want to increase your credit limit. So by increasing your credit limit, you will actually improve, in most cases, improve your credit score. But keep in mind, it's dependent on you managing your finances well. Should I pay off my credit cards and then close the account? When people are preparing for a mortgage, I always tell people, pay off the smaller balances as quickly as you can. Don't apply for new credit. But if you're paying off your credit card, do not close the account. It will have a detrimental effect to your credit rating, because one of the criteria for assessing somebody's credit profile and credit rating is how long they've had credit. So let's just say you've had a credit card for 10 years, you've managed it well, you've paid it every month, and now you're preparing to get a mortgage, you decide to pay it off, but then you close it. If that's the longest standing credit card that you've had, when you close that, it will reduce the average time of credit that you've had, and it will therefore impact your credit rating. So you don't want to do that. Another common question that people ask me is, what is the difference between a statement date and a due date? And this is really important, especially for people that are looking to improve their credit rating. So what some people will do is they'll go out, they'll get a credit card for the purpose of improving their credit rating. They'll purchase something on it. Let's just use January, for example. So they get the credit card on January 1st, 2nd, 3rd, they go out and they put a charge on that credit card. And then what they do, because they think this is a good idea, they'll pay it off in a couple of days. You don't want to do that, because what will happen is when your statement cycles, it will show that there's a zero balance on it. What you do want to do is use the credit card responsibly, have a balance that when the statement cycles or when your statement is produced, it's showing a balance. Hopefully you've set up a direct debit. You then pay off that balance. Then it will show that you're using and managing your credit well. These are some tips on how to improve your credit score, and here are some actions that you can take. When you're improving your credit score, you do want to have access to your credit score. So I recommend Check My File. The information will be in the link, but it's checkmyfile.com. You can download your 3 bureau reports. So that's Equifax, Experian, and TransUnion all in one place. It will have all of your payment history. It will have all of the searches. And as I said, it will help you pick up if anyone's done anything fraudulently. This is very, very, very important because if someone has done fraud on your account, you want to pick it up quickly. The reason why you want the 3 bureau report is because keep in mind, not every lender reports to every credit reference agency. So by having the Check My File credit report, you'll see all 3. You'll be able to pick up everything that you're paying on. And if you have any CCJs, late payments, missed payments, anything like that. And great tip, go to Money Savings Expert. Money Saving Expert is a trusted website in the UK where you can find out about mortgages, you can find out about loans, and it has a lot of consumer information. Make sure you check it out. You'll be glad you did.